for inviting me for this seminar. So today I will present my paper titled Common Ownership in Product Markets, the Role of Supply Chains. So in the last decades, we saw the growth of few large institutional investors that are providing index funds. These institutional investors, they have very diversified portfolios. In fact, they have in their portfolios ownership share of multiple companies. And sometimes these companies, they also compete in the same industry. A seminal paper of Azar, Smaltz, and Teku in 2018 identified a potential negative effect of common ownership. They focused on the airline industry, and they saw that the common ownership of rival airline companies was causing an increase in prices and a reduction in competition among companies. So the idea is that these investors, to maximize the value of their portfolio, they were reducing competition among airline companies, and to increase their profit, they charge high prices to the consumers. Since then, since this seminar paper, it has started an entire literature on common ownership. And in particular, there is an open debate on what are the consequences of common ownership. And especially the focus is on the product markets. And in the literature, there is mixed evidence. Some papers, they find that common ownership has effect in product markets, negative effects. Others, they don't find any effect. So what I do in my paper is to ask the following question. Should we expect common ownership to reduce competition in all the economic sectors, or maybe just in few of them? And to answer this question, I build on two main observations. The first is that common ownership is about the old economy, in the sense that these index funds, they hold rival companies, not only in one given sector, but this happens in almost all the economic sector. So in particular, in my paper, I document that 70% of the level of common ownership is a sort of economy-wide common ownership. So it's about not only one sector, but it is about all the sectors at the same time. And so this investor, this index fund, they want to maximize not the value of a single investor, of a single sector, but the joint value of the portfolios that include multiple sectors. And here it comes my second observation. And it is based on the following, that the sectors, the economic sector, they normally operate along supply chains. The product of one sector, it is often sold to other sectors. And in particular, in my paper, I document that on average, 40% of the sales of a given sector, they are not coming from consumers, but are coming basically from other sectors. And from this, we can think that it may be a good idea from the point of view an investor, in order to maximize the value of one sector, to reduce competition. So the idea is that if you reduce competition in one sector, you basically trade off less quantity with high prices. And this will allow to increase the profit of the sector. But on the other side, this less quantity produced in the sector may have a negative effect of the supply chain. If you produce less in a sector, maybe the profit of the supply chain of the other sectors that are interconnected may also be reduced. So for this reason, in my paper, I argue that to consider the effect of common ownership, we need to jointly consider the externalities, not only within sector, but also across sectors. And building on these two main observations, in my paper, I develop some hypotheses. In particular, I have a theoretical part in which I consider the following model. I consider firms that are operating in sector along a supply chain. And I assume that all these firms operating along a supply chain are under common ownership. Basically, there is one common owner that owns these firms along the supply chain. And given this situation, I solved the model by trying to understand what are the product market policies in terms of competition, like in more competition or less competition, that maximize the profit of the supply chain. And my main finding, that is based almost entirely on the double marginalization of Spengler 1950, it is the following. The profit of the supply chain, it is maximum if competition, it is reduced only in one sector of the supply chain. Instead, all the other sectors, they must be competitive. Then, given that this main finding coming from Spengler 1950, it is agnostic about the sector in which competition should be reduced, I create a more complete model, allowing also for the presence of relationship-specific investment. So once I make the model more realistic, I try to recompute my results, I find that competition should be reduced in one sector, but in particular, this sector should be the sector that is selling to final consumers. Basically, it should be the downstream sector. So to summarize, for a given supply chain, it is optimal in order to maximize the profit, it is optimal to reduce competition only in one sector, and this sector should be the downstream sector. Then I do also an empirical analysis in my paper, and in particular, I do my analysis at industry level, and I consider the sample period from 1985 to 2017. I first document new facts about common ownership. Basically, the main thing that I document is that I document that in most of the cases, the common owners, the investors that all the rival companies in one industry, at the same time, they also hold rival companies in vertically related sectors. In particular, I document that the growth over time in common ownership in the sample period, it is driven by these investors that are also vertically related. And in particular, I find that in 2017, that is my last year of the sample period, 70% of the level of common ownership in a given industry is driven by investors that also have holdings in vertically related sectors. Then, after having documented the importance, basically the prevalence of this type of common ownership, I test my main hypothesis. In particular, my main hypothesis, I find that this common ownership along of the supply chain is associated with higher markup, higher profitability in more downstream sector, and on the other side, with lower markup and lower profitability in upstream and intermediate sector. And these results are consistent with the theoretical prediction. Then I also try to establish causality. And to establish this, I rely on two main additional tests. The first one is that I use an alternative measure of common ownership that it is less endogenous. The second test, that is the most important, is that I rely on the quasi-natural experiment of financial institution mergers and I take advantage of this change in common ownership to see what is the effect on the profitability of the firm. And I find the results that are consistent with the prediction of the model and with also the other baseline results. So about the theoretical part, my theoretical part contributes to a literature that study what are the implications for an economy under common ownership. Most of the paper, not all of them, but most of them, are based on one sector economy. And to study common ownership, researchers, they use basically two main methods. The first, it is to rely on partial equilibrium model, as in Hazard 2011 or Hazard 2020. Here, the idea is the following. There are some asset owners that they want to maximize the value of their portfolio. And in order to do this, one thing that they can do is to reduce competition in the sector of the economy. So basically, partial equilibrium models, they predict that common ownership has anti-competitive effects. Then there is a second type of models that are based on the general equilibrium types. In this model, these models are more complete in the sense that asset owners, like individual people, on one side, they invest their wealth and they basically buy stocks, so they are common owners of stock. But on the other side, they are also consumers. They consume the goods that are produced in the economy. And it can be shown that by considering this general equilibrium model, common ownership in general does not have anti-competitive effects, because high prices that are basically gains from your portfolio, they come at a cost of high prices for the good that you consume. So the idea is that these two forces, they cancel out. So common ownership does not have anti-competitive effects in case of general equilibrium model. However, this model, they tend to be not realistic because there is heterogeneity among asset owners in terms of portfolios allocation, but also in terms of consumption decision. Even general equilibrium. In my paper, I contribute to this literature, and in particular, in my paper, it is based on partial equilibrium models. And one contribution is that I specifically focus on supply chains. It's the first paper to focus specifically on supply chain. So this allows me to jointly consider horizontal and vertical externality among firms in the supply chain, and to predict that these anti-competitive effects from common ownership, they are originated from downstream sectors. These are my contribution to the theoretical literature. And so to do so, I start from a general model, and then I focus on a simplified case of two sectors. But so the idea is that in the general model, I consider a number of sectors, like n sectors, and I assume that there are input-output links among sectors. The product of one sector is sold to other sectors. In particular, I studied the firms, and I assume there are n firms and are distributed in S indices. And second, I assume that there are externalities among the firm. For instance, one decision in terms of quantity to produce on one firm have an effect on the other firms that are in the same sector, but also in other sectors. Given the firm in this economy, I make an assumption about the ownership structure. And in particular, to make it simple, I assume that there is common ownership. To generate common ownership, I start from the following idea, from the following assumption. There are G shareholders, and I denote with theta JN the ownership share of the shareholder G in firm N. So every shareholder gets utility basically by the sum of the profit of the firm that is having in its portfolio, as you can see from the equation there. So the utility depends by the profit of the firm, weighted by the quantity, basically the ownership share of the firm that you have. And in particular, so this is the general structure. As I mentioned, in my paper, to derive the prediction in a more simple way, I basically consider a two-sector economy. And in particular, I consider two sectors, an upstream sector and a downstream sector. So there are U upstream firms, and each upstream firm incurs a cost C, and incurs this cost is to produce an intermediate good. And these upstream firms, they sell the intermediate good to downstream firms at a price PU. Then I assume that there are D downstream firms, and this downstream firm, after having bought the good at a price PU, they sell it, basically the final good, after some production, to final users. For simplicity, I assume that the final demand has a constant price elasticity function. And more importantly, I assume that firms in both sectors, they have a production function that entails constant returns to scale. So this is about the firms in a two-sector economy. And here you can see the graph with the representation of these. So the circles are the firm. In particular, the green circle on the left are the upstream firm. In the middle, there are the blue circle that are the downstream firms. And finally, on the right, there are the final users. So for this supply chain, I assume that there is common ownership. As I mentioned, there are G shareholders. And to generate common ownership, I assume that each shareholder is completely diversified. Basically, each shareholder holds stakes in all the companies in the economy of the supply chain, in this case. And this basically creates common ownership in the economy. So basically, each shareholder wants to maximize the value of their portfolio, given that all the shareholders, they have the same portfolio, the market portfolio. Everyone wants to maximize the same amount. Basically, this value is the sum of the profit of the firm in the supply chain. Basically, you need to sum the profit of the upstream firms plus the profit of the downstream firms. So in this situation, we are basically in a situation in which there is common ownership in the economy, and there are this firm in the supply chain. And in my model, I assume that shareholder can choose what to do in terms of product market policies in the sector. Basically, the idea is that shareholder can choose if to promote competition or if to reduce competition, and also they can choose in which sector to do it. So I look for solving this model by choosing in which sector competition should be increased or reduced. And what I find is that the total profit of the supply chain, it is maximum if competition is reduced in one sector, while the other sector, it is competitive. And this total profit, that is maximum, is the same that it would have been obtained if the N firm, they were acting as a single monopolist. So this result is derived basically, but it's basically the double marginalization of Spengler 1950. I also extend this result for a supply chain with N consecutive sector. In this case, the profit of the supply chain, it is maximized when competition is reduced in one sector, and instead the remaining N minus one sector are competitive. So far, the model, it is agnostic about the sector in which competition should be reduced. So for this reason, I make the model more realistic. And in particular, I allow the possibility that upstream and downstream firms, they can make relationship-specific investments. So what are these relationship-specific investments? these are just investments that can be either cost reducing or demand enhancing. It means that they can sell more. And if these investments are made, the total profit of the supply chain can be increased. And normally, a typical problem of this is that in many cases, many firms are reluctant to make this relationship-specific investment. One main reason that is coming from many theory and evidence in industrial organization is that once a firm has made this investment, the cost become sunk. And so it is possible that if this company is interfacing with trading partners that have more bargaining power, this trading partner, they may appropriate of all the revenues, of all the surplus. So given this, ex ante, it is possible that many firms, they don't make this relationship-specific investment, and so this is not good for the supply chain because the profit is not maximized. So in my model, so I solved the model before, choosing about the sector in which competition should be reduced, but considering the fact that also firms have to make this relationship-specific investment. And in particular, after solving the model, I prove that the sector in which competition should be reduced, it is when downstream firms interface with final user. So in that case, competition should be reduced. On the other side, all the internal sector of the supply chain, basically the upstream sector, should be competitive. And the reason is that competition, it is a way to solve this hold-up problem that is arising. The idea is that by having competition among companies, it is prevented the possibility of that these companies have bargaining power. So this increases the possibility that firm makes ex ante this relationship-specific investment. On the other side, we assume that the vertical relationship in terms of this investment, they don't exist when the downstream firms are interfacing with final users. So for these reasons, competition should be reduced in this sector in which this relationship-specific investment, they may not be damaged. So to summarize, my main theoretical prediction are the following. If you consider the common ownership of sector along a supply chain, that is basically the focus of my paper, the prediction is that anti-competitive effects, basically competition should be reduced only in the downstream sector, and instead there should be pro-competitive effects in the other sectors of the supply chain. On the other side, in case there is an investor that holds a rival company only in one industry, but not in others, and especially not in vertically related sector, in that case, common ownership should reduce competition. And I test that this prediction in the...
Camillo, please excuse me for interrupting. According to the clock, we have something like 3.5 minutes. So before you go to the empirical part, if you don't mind, let's disconnect for a little bit and let's reconnect in order to continue, okay?
Okay, sure.
Okay, perfect, thanks. And you... Okay.
So as I mentioned, I test my prediction in the empirical part. Before going there, I wanted to mention you that there is a very large literature, empirical, on the effect of common ownership. In particular, there is a literature that studies what is the effect of common ownership on competition in the sector and so on quantity and prices of the goods. There are studies that focus on single industries, like in the airline industry, in the banking sector, in the cereal industry, there are also studies that focus across sector. They don't study only one industry, but many industries at the same time. And there are also studies that focus on common ownership at firm level. And on the other side, in addition to this, there are empirical studies that basically look at other aspects of common ownership, in particular if common ownership has impact on the entry of the firm in product markets, and if common ownership has impact on the innovation of the firms. So in my paper, I contribute to the first literature that studied the effect of common ownership in product markets. And but the addition of my paper is that I focus almost entirely on supply chain, and I find that common ownership has different effects in terms of markup and profitability in different sectors of the supply chain. So to derive my prediction, I create a dataset at quarterly level. And as I mentioned before, I consider a sample period from 1985 to 2017. I obtain data from the firms, from their financial statements, from CompuStat. And in particular, I focus on US firms. Given this firm level data, I aggregate them at industry level. In particular, I use the 4-digit NAICS as an industry definition. And so my main focus is at industry level. And I also collect data on the holdings of institutional investors. And for doing this, I rely on the dataset Thomson Reuters 13F, that it is coming from the quarterly reportings of institutional investors. So I start my empirical part by creating the traditional common ownership measure that is at industry level. And this common ownership measure, it is called the MHHI delta. Basically, the MHHI delta wants to see what is the extent to which the company in a given sector, they have the same owner. Basically, more companies have the same, more different companies in the same sector, they share the same owner, greater it is the common ownership measure. And this common ownership measure, it is computed in 2 steps. The first step is basically computed the level of common ownership generating by each institution. For instance, if you want to compute the level of common ownership generated by BlackRock in the airline sector, in a simplified way, you need to compute the product of the holdings of BlackRock in all the rival companies. If it has like 5% in one company and 10% in the rival company, the common ownership is 5% times 10%. So greater the extent to which you own competitors, greater is the common ownership measure. So you need to do this for all the investors in a given sector. And then after that, you sum this common ownership across all different investors. This is the traditional measure of common ownership. And here it is just an example with 2 airlines, airline A and B. There are 3 investors, BlackRock, Vanguard, and an hedge fund. BlackRock has 7% in both companies, Vanguard 5% in both companies, and an hedge fund 5% only in one airline. So the level is given by, basically the MHHI delta is given by the common ownership of BlackRock, 7% times 7%, plus the level of common ownership by Vanguard, 5% times 5%, plus the level of common ownership by the hedge fund, but in this case it is 0 because it owns only one company. So this is just a simplified example to see how to compute the common ownership measure. And the contribution of my paper is the following. In a given industry, and basically for each industry, I decompose this MHC delta in the following way. I want to see for each investor that is having common ownership of the company, if this investor is having also holdings in vertically related sectors or not. In case this common ownership is having holdings in vertically related sectors, it goes to the one component of MHC delta. It is called VertCo. Instead, if this common owners does not have companies in vertically related sector, it goes to the other component. So as you can see, the total MHC delta can be decomposed in two components. One part is driven by investors that are also diversified, vertically diversified, basically investors that also have rival companies in the supply chain, plus the other part of common ownership that is given by investors that they only have common ownership in that industry, but they don't are common owners in vertically related industries. To compute this, I need to understand when two sectors are vertically related. And for doing this, I use the notion of cost share. Cost share is basically the extent to which a sector it is purchasing input from other sectors. And to compute the cost share, I basically proceed in the following way. The cost share between two sectors, I do the first thing, that is to compute the dollar flows between the two sectors. And for doing this, I use the BEA input-output tables. Once I have that, I compute the cost share. Basically, I divide the purchase of a sector given the total cost. And the two sectors are considered to be vertically related if the cost share is at least 8% in one direction, and it is consistent with the recent literature on vertical relations. To give you an example, so there are 269 industries based on the NAICS 4, and from that, I derive 666 pairs of vertically related sectors. And here you can see the composition of common ownership over time in the average industry. The line on the top is the blue line, and this is basically the MHC delta. As you can see, this MHC delta is increasing over time as common ownership was increasing in the last decades. So, and then the green line is one component, and it is the part of the common ownership in a given industry that is driven by vertically related investors. As you can see, this green line, it is a prevalent part of MHC delta. In particular, in 2017, this green line, it was 70% of the total of the blue line. And all the growth in time series, it is driven, most of the growth is driven by vertically related investors. And in my paper, I specifically study what is the effect in a given industry of common owners that they also have holdings in other sectors, vertically related sectors. To finish with the variable within the independent variable, I also need to determine the position of the sector in the supply chain. And in particular, I want to see if a sector is downstream or upstream. And for doing this, I create a measure of downstreamness, and I compute in the following way. For a given sector, I consider the proportion of sales that goes to private consumption, private investment, and export. And I divide this by the total sales. So more sales goes to consumption, private investment, and export, more the sector it is downstream. This was all about my independent variable. Now I go to my main dependent variable. Here I use two dependent variables that basically are the profitability of the sector. The idea is that any change in competition in the sector should have an impact on the profitability of the sector. For this reason, I use two measures. One is the markup that is based on the EBIT, and the EBIT is the operating profitability. Then I use a second measure that is called the price cost margin, and this second measure, it is more based on a similar profit, it is very similar to before, with only different that I use a different notion of profitability that includes as a cost only the cost of goods sold. And here are the summary statistics. First, about the common ownership, basically MH share delta. The first row is the total. The second and the third row are the decomposition. As you can see, most of the MH share delta is generated by the third row. That is the part that is driven by investors that are also vertically related. Basically, it accounts for more than on average, more than 900 over 1,500. That is the total of common ownership. And here just, you can just see the summary statistics for the other variables, the dependent variable, downstream variable, and all the control variables, like the net capex, advertising, the presence of firm with large shareholders, the concentration index, the sale growth, capital intensity, R&D, the leverage. So I can show here the main result of my paper. And in particular, in the row 1 and 2, there is the effect of common ownership driven by vertically diversified investor. Instead, row 3 and 4 is the effect of common ownership in the same industry by investors that are not vertically diversified. As you can see from the row 1, and in particular from the row 2, common ownership driven by vertically diversified effector has an effect on the profitability, on the markup, only if the sector it is downstream. So this is the interaction term, is the second row. As you can see, the coefficient is positive. More common ownership in one sector that is downstream, if the investor it has also holding in other sector of the supply chain, is associated with higher markup. On the other side, you can see the first row, that is the common ownership driven basically by vertically diversified investor, but in other sector of the supply chain. Is not the interaction term, is basically every sector that is not downstream. In that case, as you can see, the coefficient is negative, even if it's not statistically significant. So the idea is that for this common ownership in the supply chain, there is an effect on downstream sectors. On the other side, when I consider the common ownership by investors that are not vertically diversified, for instance, you can think an investor that have holdings only in one industry. In that case, this common ownership has a positive effect, that is the row 3. But as you can see in row 4, this effect does not depend on whether the sector is downstream or upstream. The idea is that for every sector that this investor they have, they want to reduce competition. And this does not depend if the sector is downstream or not. So these empirical findings, they can be reconnected to the literature. Because in the literature, there is a paper that on which I base my empirical analysis, that is basically Koch and co-authors 2021. In this paper, they find that MH share delta does not have an effect on profitability on average. In my paper, I show that this non-effect on average on profitability by common ownership is driven by an effect in downstream sector that is driven by certain investor, and basically no effect in upstream sector. Basically, I reconnect the no effect in a paper in the literature by showing that this effect is driven, this no effect is driven by a positive effect in some sector and negative effect in the other sector. And so consistent with my theoretical prediction, common ownership has effect only in some sectors. Then in the final part of the paper, I try to establish causality. In general, all the models that they put, they create regression models between ownership and competition, sometimes are not well specified, and it is possible that there are endogeneity concerns. In my case, these concerns are quite limited because the predictions are very specific. So common ownership has effect only in one sector and not others. However, it's still possible that other factors, for instance, reverse causality. One example may be that investors, they tend to invest more in downstream sectors that have more profitability, may create some correlation. So for this reason, to show that the are driven by the behavior of common ownership, I ran two additional tests. One, it is based on considering, and it is the most important, a plausibly some exogenous change in common ownership that is not driven by the willingness of the investor to buy common companies. And there is another test that is based on an equally weighted measure of common ownership. Here, the idea is that the M-share delta is based on the sales. So, and these sales are also present in the dependent variable. So there is an intrinsic endogeneity in this model driven by the presence of the same variable in both independent and dependent variable. And for this reason, I create an equally weighted measure. And I start with this second one, that is the equally weighted measure. It is exactly as before, but the only difference is that in this measure, I don't weight companies by the sales, but I give to each company the same weight. And as you can see here, that is basically the replication of the result before, with the only difference that the measure of common ownership is different. I confirm that the results before, they also hold when I consider this different measure of common ownership. Then, in the last part of my paper, I saw do this more important test of considering exogenous change in common ownership. And for doing this, I rely on one situation, and this situation is that when financial institutions merge. And this happens when, for instance, BlackRock and Barclays, they merge in 2008. In that case, they merged their portfolios, and so they created a new, bigger portfolios, and this more portfolio was having more common ownership. And in particular, I consider 64 mergers that are in the sample period in the same sample period, and I follow the literature, especially the paper Llewellyn and Lowry 2019. So for each merger, I basically compare the common ownership before and after the merger. I consider 12 quarters before and 12 quarters after. As you can see from this table, the first thing is that, and it is what this table about, it is just to show that these mergers between asset manager, they create more common ownership. And in particular, they affect a number of industries. And these industries they go in the treatment group. And on the other side, non-affected industry, they go in the control group. And here you can see the result of this natural experiment. And as you can see, these mergers, they generate an increase in common ownership. They generate then an increase in profitability only in downstream sector. Instead, as you can see in the second row, the coefficient without interaction is basically all the other sector, upstream and intermediate sector. In that case, the coefficient is negative. So an increase in common ownership, to summarize, has increased the profitability on its downstream sector, and instead it has reduced the profitability of upstream sectors. So to summarize my paper, there was a growth, and to conclude, there was a growing common ownership in the last decade. There is an ongoing debate of what are the effects of this common ownership. In my paper, I specifically document the common ownership in the industry. It is specifically driven by investors that also have holdings in vertically related sectors. And in particular, I predict anti-competitive effects in consumer-facing sector. And I also find evidence of this. And my finding, they are generally consistent with the mixed evidence in the literature. One implication of my paper is that common ownership should have my implication is that antitrust attention should be concentrated at first in downstream sector, where common ownership is more likely to have anti-competitive effects. So thanks a lot to the audience.
Thank you, Camillo, for the very interesting presentation. I will stop recording.